Hey guys, welcome to the COM Dollar Technicals for September 26th to September 30th for Aussie dollar, dollar CAD, and Kiwi dollar. The COM dollars this week sort of all went their own different way for a whole bunch of variety of reasons, but ultimately they still maintain, I think, their near-term outperformance. And the reason being, of course, is especially with the Australian dollar, because the yield still stays in place. The most interesting takeaway, I think, from this week was, of course, the Fed held off on raising U.S. rates, therefore making the carry trade viable until December at very minimum. Australia, as a matter of fact, looks very much like it's just simply going to be in a holding pattern because China is not really getting any worse, and therefore the RBA is very unlikely to move rates at all in one direction or the other. The New Zealand story was much weaker, mainly because the RBNZ was much more dovish in its statement. But here's an interesting point. It may be much more dovish in its statement, but the underlying economics with New Zealand really don't merit any more than just the last 25 basis point cut that the RBNZ has planned for the year. So it's going to be interesting to see just how poorly New Zealand acts going forward, because ultimately the fundamentals don't merit the kind of sell-off that we saw so far. New Zealand still has the highest yield amongst all the industrialized nations, and even a 25 basis point cut will still leave it ahead of the pack. Given the fact that dairy prices have risen, I think, 5 months in a row, that growth still remains quite positive, that there is still quite a lot of overheated real estate action in the Auckland market, it just seems dubious that the RBNZ is going to go aggressively in an accommodative mode, and so the market selling off on the Kiwi is maybe an overdone reaction. And of course, the Caddy was probably under the biggest bunch of assault because everything was horrible. The Canadian economic data was much poorer. Oil prices just can't seem to get up off the mat, still underneath the $50 level. And of course, our BOC remains highly accommodative. And we're kind of probing sort of the upper end of the range for dollar CAD. What you really need for dollar CAD, of course, to break out to the upside is a pretty serious conviction by the market that U.S. rates are going up, because of all the COM dollars, it's the Canadian dollar is most vulnerable to an increase in U.S. rates, since that would create a much more favorable trade towards the dollar on interest rate differential. So it'll be interesting to see how it trades out this week. We don't have much data. We do have some Canadian data. We have the GDP data at the end of the week on Friday. That's about the only major data set that we have across pretty much the whole major, all the G11 environment and landscape. So therefore, maybe we'll have to, we'll see further dollar CAD weakness. We are coming up to that upper end of the range, which we'll look at it in charts, and therefore could be quite interesting as far as the price tests go. For the Aussie, the support still stays at the 75, resistance very much at the 77.50. As much as Aussie has shown some strength, there is quite a lot of resistance at the 75.50 level. I'm sorry, 77.50 level, and therefore I think it's going to have a much harder time making much further progress this week, especially amidst the very low news environment. Dollar CAD is really inching towards that 133, and that could be a key tipping point, especially because we're looking at oil. If, like for example, if oil gets down close to 40, and perhaps even if oil breaks 40 to the downside, certainly 133 goes through through the roof, and that makes dollar CAD the weakest of all the COM dollars for sure. Even though it's been that way for quite a while, that trend very likely is going to continue. And Kiwi, now having come close to the 72 level, may be starting to bounce back because the yield is still there, and we don't really have any New Zealand data coming up this week of any. But we do have like trade balance data, which comes up literally at the front of the open on the Asian Open on Monday morning, Sunday night for us. That could possibly drive us down below the 72s in the near term, but ultimately. I think the New Zealand dollar just simply gets too much support out of the yield at this point to really see any further downsell from these levels, no matter how much the RBNZ wants to see it lower. So let's take a look at the charts here and see where everything stands. So let's look at the Aussie first. And as you can see, Aussie clearly showing a very nice bounce off the 74.50, nice double bottom, just sort of a classic double bottom trade. But as we come up here now, we're really, this whole area, the 77.50 area, a very serious resist area. So maybe there's another 100 points of the upside in the Aussie. Aussie's really backed off the 76.50 the other day. I think very likely this could become a pretty chunky area here. Any kind of dollar strength does puts us back, but a decline back down, probably a very attractive buy here, because I don't think that you see sort of a massive liquidation from the Aussie, since the carry trades, as I said, still stays alive at the very least until December, and therefore it's going to attract a lot of bargain hunters anytime we can come down to the 75.50. There's nothing on the horizon that augurs a very poor Australian environment, and therefore a chance of an RBA rate cut. And until you see that, the Aussie looks to be much more of a buy to dip story than it is a sell to rally story. On dollar CAD, this is where we're now coming up to the top of the range here, and we had a big move on Friday. Oil prices came down, dollar kind of rallied. So the 3,200 level is the very big resist area, and if we go, let me just sort of go out a little longer, maybe a year or longer, you can see that this is really sort of the 32 to 33 is the big. You really almost can call it the 32 area. If we break above 32, it puts us squarely now into a position of a possible move up to 35. So the first break to 32 could be a move on oil, and the move to 35 would be a move on U.S. rates going higher. That would be the trade. I have been, if you guys have been listening to me from the beginning of these video casts, that dollar CAD has always been my favorite trade to on buy to dip. It hasn't disappointed me yet, and it continues to be, I still think, a kind of a buy to dip trade continuously. It's still the weakest of all the calm dollars, and if you think that there is a chance of a dollar hike in December, this is one of those trades that makes sense to pick up anytime we dip into the low 30s. The fundamentals on the Canadian side much worse than the fundamentals on the U.S. side, so there's very little here to merit a sharp move to the downside, except possibly a sudden and completely unexpected rise in oil. If there's an exogenous shock, yes, then it's a completely different story. But until, I think 28 is broken to the downside, this is pretty much a buy to dip story continuously. You see a series of higher lows, and a break above the 132s only confirms the fact that this could be a much more meaningful break with a potential move towards the 135s. So very much worth watching here on that basis as we go forward. And then lastly, looking at the Kiwi here, so Kiwi certainly showed a lot of weakness this week off of a pretty dovish RBNZ. It definitely had a big spike high at the 75 and tremendous amount of distribution here. But now that we're coming up to the 72 level, and let's just kind of put that over here, the 72-71 corridor is clearly a pretty big support area. This was the big distribution area. Now it becomes a pretty big support area. I really like buying the Kiwi. If I could get a chance to buy Kiwi underneath 72, with a stop below 71, I think it's a very reasonable trade, because I don't think Kiwi is sort of a one-way dive here to the downside, given the fact that we have the yields and we have the fundamentals on our side, and it's very corrective. Now, yes, does this look distributive? Absolutely. Does this look like sort of a head and shoulders formation? Yes, but it's sort of a head and shoulders that's coming into support, and I'd much rather be on the opposite side of that move, because I think the bounce to the upside will be preserved. Conversely, you can also see here that even though it's maybe distributive, the move to the downside here would take us still into essentially the uptrend support. Sorry, this chart moved off here, but basically, we broke the trend, the diagonal trend line support here, but we still remain very much on the higher lows movement here. In order for us to really have a full negative bearish view, this whole move would have to break the 71s and create a fresh set of new lows. So I like this on a buy to dip territory right in this 72-71 area, with a very minimum, at least a bounce back up towards the 73s. So that's kind of how the Kiwi sets up. Of the order of priority in terms of strength, it still looks to be Aussie, Kiwi, CAD. Although one of the more interesting things, and we'll take a look at it in the crosses perhaps, is the fact that the Kiwi, if the Kiwi finds any kind of a support here, right underneath the 72 level, could actually begin to outperform the Aussie after a corrective move last week. So that's how we go on the calm dollars, and we're going to do the crosses next.